All right, welcome to the show. Be the boss of your money. Thank you so much for joining me today. If you don't mind, give us a like, ask your questions in the comments. We always talk about investing, personal finance, anything to do with money, really, business, setting goals. It's important stuff. And, the idea is that you watch the show, you become better at life, in particular, your financial life. And if you're better in your financial life, that does rub off on a lot of other parts of your life. So I want you to watch the show. I want you to enjoy it. I want you to get a ton out of it. The market has been going down. The decline this week is starting to get serious. We're seeing some pretty big drops, even though 500 points, like it was down today in the Dow Jones Industrial Average. It's not the hugest day for an index not far from 40,000, but nonetheless, the down days are starting to add up. What gives? What happened? What changed? And if I was a betting man, I would say we could be facing a test, our first real test in quite some time. I'll roll a quick introduction. We'll get into it. I'll let you know what I'm talking about. Here we go. All right, I'm Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money. It's about money, taking control of your money. If you don't take control of your money will take control of you. So here is the deal. The market's starting to feel wobbly. Averages are down. The VIX, the volatility index, had a pretty big pop today, over 10%. So what are we going to look at here today? Let's go back and say that since November, the market has been in all-out rally mode. So we're about 7 months into a really big rally on top of a good year last year. But this has been a pretty big rally. And you've seen artificial intelligence stocks in particular. NVIDIA became the new stock market darling. Anything associated with artificial intelligence has been taking off. Crypto made a massive resurgence. Bitcoin hit a new all-time high. Small caps started to work out and interest rates were going down. But it seems like a lot of this is reversed. Okay, a couple of things. First of all, when the market has big rallies, whether you're talking crypto, stocks, bonds, any kind of market that has a big rally, the fish market, usually what happens is it's not a straight line. You get pullbacks. They go up, they go down, they go up, they go down. Hopefully they go up a little bit more than they go down. But nonetheless, when they go down, it could be scary for investors. I just want to say, when I use terms like the Dow Jones Industrial Average or the S&P 500, I have to say that you cannot invest directly into an index, but you could invest into a security that tracks or mimics an index. So what are we looking at today? A couple of things that the rally was built up on. Okay, the first one and most important one was the expectation that the Federal Reserve would cut interest rates. Our base case here, for me anyway, was 2 or 3 rate cuts for the year. Investors got excited about it. Maybe they thought we could see 5 or 6 rate cuts. I try not to yawn, but it's been a long day. I get an early start to the day. Okay, so and then that was kind of walked back a little bit, and then maybe we'll get 2 or 3 rate cuts. But investors are cool with that. Market had a dip, then we started to come back up. But I'm telling you for a fact, Federal Reserve officials, in particular voting members of the FOMC, the Federal Open Markets Committee voting members, are walking back their expectations of rate cuts. And now some of them are saying maybe only 1 rate cut this year. We need to see further evidence that inflation is pulling back. What they really are also saying, reading in between the lines, is if the economy is chugging along at a pretty good pace, unemployment remains low, why does the Fed need to cut interest rates? If anything, the Fed should leave rates higher for longer. They don't want to cut too soon. They don't want a resurgence in inflation. And if the economy is humming along with a higher interest rate, it behooves them to leave it where it is. If all things being equal, if you could have 5% interest rates on the Fed funds rate or 4%, you might as well take the 5% if all things being equal. Plus, this is a pretty good market for savers. This is the best time for savers that we've seen in over a decade. People who have money in cash, CDs, T-bills, cash equivalents, okay, savings accounts, high yield money markets. People are finally making money again on their money without taking a risk to their principal. People are feeling pretty good about it. So not all bad, and cash balances in brokerage accounts are doing pretty well. And, you know, at least part of your money, is getting 4 to 5% in something that is stable with preservation. So what we need to see, though, is what happened with the Fed. So a number of Fed officials are walking back rate expectations. Neil Kashkari from the Minnesota Fed branch said we might not even need any rate cuts this year. So it's been pretty aggressive to see Fed officials cut the rate expectations. And now the Fed chairman, Jerome Powell, is joining the course and cutting back his expectations for rate cuts. So you add it all up, a lot of the built-in gains in the market were based on Fed cuts. The Federal Reserve raises interest rates to pull money out of the economy, to make it more expensive to buy things, to finance things, to get anything done, to build things. Yet the economy is still doing pretty well. So that is what the main culprit behind the market going down. The next culprit is the price of oil. U.S. crude has been surging. There's been skirmishes between Israel and Iran. You've seen it in the news. If you haven't, Israel bombed an Iranian consulate in Damascus, killing 7 Iranian officials. And Iran swears that they're going to retaliate. I don't know if the U.S. told them that if you do retaliate, then we're going to retaliate against you. But nothing has happened yet. Do I think something happens? Actually, I don't. That's just my own personal opinion. I'm not a geopolitical expert, but I do follow geopolitics very closely because it is a big passion of mine to follow this stuff. I think it is incredibly interesting. So we have strife in the Middle East, and that's starting to affect oil markets. And we have Ukrainians striking deep, very deep into Russia, hitting oil fields and chemical plants. And Russia does not really have a lot of storage capacity for energy. What they do is they pump oil and they ship it out as quickly as possible to buyers, international buyers primarily. So when there's interruptions in the flow of oil at the wellhead, they have to stop production, and that's a very difficult thing to stop production. Plus, wellheads could close permanently when they stop flowing, and then you have to re-drill. It's a tedious process, and it's a process that really can't be interrupted. But the real deal is that Ukraine has been able to strike deep into Russia, and they're probing for weaknesses, and they're finding weaknesses like no air defense in the middle of Russia. It's all on the sidelines. It's all either on the east coast or the west side. I should say it's all on the west coast or east side because they don't really have a east coast. They buttress Europe. So those are the things that are going on. Tomorrow we have the March non-farm payroll report. It's expected to be about 200,000 jobs created. Unemployment rate should be about 3.8%. If we see anything stronger than that, I think stocks take a big hit. Stocks go down because then it's really interest rates off the table, out of here. And now investors have to wonder, are they discounting future earnings correctly? And maybe they open their eyes and say stocks are too high. And I'm only saying all this because I'm making a big deal about it because the market's already up a lot. And I feel like the market is starting to go down now, and it's looking for a justification or an excuse to validate the recent slippage in stocks. So what to do? We will see. I don't think there is anything out there to really change the direction of the market until next week, when we start to get the first quarter corporate earnings coming in, and we'll see what corporates have to say about what they see for the rest of the year and what they see for the next quarter, et cetera. That's going to be a really big deal. But ultimately, if interest rates don't calm down, it's going to be really tough for the market to resume its rally. Let's take a quick look at a couple of things over here. I'm going to put you on my other screen. All right. So you have a Dow down 530 points, NASDAQ down 228. That's a pretty big jump, pretty big bump, down 1.4%. S&P down 1.25%. Gold off a little bit. 10-year yield 4.31%, but the VIX up 14%. So things are starting to get a little bit worrisome in stock market world. And let's take a look at everybody's darling stock. Okay. NVIDIA down $30 to $8.59. So NVIDIA is down well over $100 a share from its recent peak. So it's like a $97 stock. You see that going down to $8.59. So $97 stock going to $85. You're starting to talk about a pretty significant drop in the price of a stock that is up a hell of a lot. And if investors who are Johnny come lately start to see their recent profits evaporate, you better believe more people are going to want to protect what gains they have left. They're going to sell it, pressuring people who have the stock even at a lower price than them. And it becomes a self-fulfilling prophecy of whoever sells first wins. It's a competition that we don't want to see stocks get into, but it's it's the exact opposite of the competition that pushed the stock up to begin with. So that's what's going on. And when you have these big tech stocks go down, well, Tesla was up a drop after a severe downturn, and Meta was up a little bit. But Apple, Microsoft, Amazon, Netflix, Google, NVIDIA, and other big stocks were down. So when those stocks are down that much, it's really hard to counteract that with gains in other stocks. Remember, there are a lot of stocks that you might see trading up or down, but very few stocks actually have the heft to impact what any of the major averages do. So when you see a small stock go down that's in the S&P 500, I know that sounds weird to say small stock in the S&P 500, but the difference between the top 10 stocks and the bottom 10 stocks is so significant that if the bottom 10 stocks of the S&P 500 disappeared, just went to zero, you wouldn't even notice it. It would be maybe at most a rounding error in the final tally of the S&P 500 index of how it did on the day. So that's my story. I'm sticking to it. Stay tuned. Keep watching me. I'll keep you posted what's happening in the market, what's happening in personal finance, things that you could be doing to improve your lot in life. With that said, I'll be back. Well, tomorrow is already Friday. If anything crazy in the market happens, I'll do the live stream tomorrow. If not, I'll be back Monday. Have a great day, and thank you so much for joining me.